Okay, so let's look at the difference between interest rates versus the total cost of a loan. Now, I'm going to say something here that some people might not agree with, but that the interest rate on a loan is almost irrelevant compared to looking at the total cost of the loan. So the total cost of the loan is a lot more important than the interest rate, because the interest rate is only one portion of the cost of getting a loan. When we look at the total cost of a loan, that includes all the fees and charges as well as the interest. So if you look at the total cost of the loan, that way you're really capturing how much that loan is costing the client. So we see so many clients that get hung up on just seeing what the interest rate is and trying to get whoever gives them the cheapest interest rate. We had an example recently of a client who had a finance option from us as well as from another provider. That other provider, their interest rate was nearly half of ours. However, once we actually looked at all their fees and charges that they had, they were actually $115,000 more expensive than us because of all those charges. So this is where we tell clients and we tell our referrers to educate their clients to look at the total cost of the loan, not just focus on the interest rate, because that's the most important thing. So let's just have a look at a bit of an example so I can show you what I mean. This is a deal that we did. It was a $435,000 second mortgage we did on an incomplete development site. The interest for a 2-month loan was going to cost them $16,530. The approval fee was just over $15,000, and there was some legal fees in there of $2,735. So all up, this loan for the 2 months was going to cost them $34,471. And you can see the interest was just less than 50% of this. So this is where it's critical to know what the other costs are. Now, when it's looking at whether or not this client should take this loan, what they need to look at is how much money they're making from this transaction. So this is the cost of the loan. Now we look at what's the benefit this loan is going to deliver. So we did just a rough feasibility on their development. So the gross realisation value, or the GRV, once the 3 townhouses were complete, was $1.95 million. They purchased the land for $650,000. They had some stamp duty. The build cost was $650,000, and we estimated their real estate agent fees and council and holding costs at around about $115,000. So all up, they were going to make a gross profit of $500,000 for this transaction. Now, when you start to look at this, you've got the line down the bottom there. Does it make business sense to give away 7% of your profit, being the $34,000, to get the deal done? Now, for a lot of people, and if it was me, to give away 7% of my profit to get the other 93 makes a lot of sense. So if you compare this to maybe a client going and getting a joint venture partner to put the money in, that joint venture partner is typically going to want, say, maybe 50% of the profits. So you can see that private lending is actually a cost-effective way to do business, and it's used by a lot of developers to get their projects done. So if you've got a client that can't get traditional bank funding and would benefit from a private loan, then send us an email to apply@privatemortgagesaustralia.com.au, or you can give us a call on 1300 856 683, or check out our website or social pages. We look forward to hearing from you soon.